All right. I did mention this is being recorded. One thing I mentioned at the beginning of all of these webinars is watch this again. And I also have a deal for you at the end that, you could, like we mentioned right before this webinar started, is I have done a webinar on long put spreads. We're going to be specifically drilling down on volatility and stuff like that and how it affects this spread a little bit more than I have in some of the past ones. So that is where you guys are going to have some really good takeaways here. All right. Agreed. Your webinars are excellent. Appreciate it. Thank you, Wally. We'll talk about some of that other stuff here in a little bit too. But let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my market commentary, geopolitical analysis, and economic viewpoint. I'm not here to tell you guys I'm going to make you rich or make you a millionaire, but I am here to help you take control of your finances and manage your portfolio. And most importantly, manage your own risk, you guys. You guys should be managing your own risk. Basically, I started out trading in college with some money I had earned, trying to get a psychology degree. And then after about a year, I decided to switch it over to finance and continued my trading. After graduating college with a finance degree, I moved to Chicago and started working on the floor of the Board of Trade. So in that time, I've traded everything from stocks, financial futures, commodity futures, and currencies, also options on all of these products in just about all market conditions. Also, please remember that any opinions, news, research, and analysis or other information contained in this webinar is to be provided as general commentary, you guys, and not constitute investment advice. The reason why is I don't know what's in your portfolio. I don't know your risk parameters. So therefore, what I'm talking about could be counterintuitive to what you're already doing. Bottom line is do your own homework. And please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's blog or follow our parent company at Pro Trader Strat. Earnings season right around the corner. I tweet out what my earnings trades are. Also, if I do these daily market commentaries every day where I talk about all of the trades that I've done, where I put them on, taking them off, whether they're winners, losers, I'm managing the risk or dumping the losers. That being said, if I do something in the morning, I talk about it in the daily market commentary. If I do it in the afternoon, I want to make sure you guys have access to that. So I will tweet out, I got out of my long deltas and SPY kind of thing. If you're following along, then you will understand exactly what I'm talking about. So you can follow me there. All right. Go over this real quick for some of you guys that are a little bit newer to options trading. I just want to talk about Delta because it's going to come into effect with this quite dramatically. Delta affects an option premium in relation to the underlying's first dollar move. And what does that mean? I mean, a dollar move here, there, what are we talking about? Basically, if we look at, let's just look at something else. I'm just going to throw in Qualcomm here for the Delta. And all right, so Qualcomm, the Delta. We're going to look at Delta over here on the side. Delta, Gamma, Theta, Vega. This is what we're going to talk about here because this is like option 101. I want to make sure that you guys are clear concept before we move on. So if Qualcomm moves from $73.38 up $1, this premium will go from $2.70, let's just call that mid-market. And that first dollar move higher, this premium will increase by the delta, 50 cents. So when this is trading 73.38, goes from 72.38 to 73.38, this will increase by 50 cents. So go from $2.70 to $3.20. Vice versa, since we're looking at the puts, we got to look at negative deltas. So if this moves higher by $1, this premium goes down by the delta, okay? So if this increased by $1 to that same 73.38, this would decrease from $1.60 to $1.25, okay, for that first dollar move higher. If the underlying moves down by that dollar, then negative plus a negative is a positive. So if we move down by $1 from 72.38 to 71.38, this would increase by that 50 cents. So it'd go from $2.70 to $3.20, okay? I'm rounding off just so I can do the math in my head, but you understand. Delta affects that first dollar move to the premium. All right. And then we have gamma. Gamma is the rate of change to delta. So think about it this way. If you want an easy way to remember these, delta is data. It gives us all kinds of data. It gives us probability. It gives us what the change of our premiums is. It gives us the probability of what touch is within that, and I'll go into that in more detail. So there's a lot of things that delta will tell you. So it's data. Gamma goes to delta. Think of it that way. Gamma goes to delta. So what that means is, by saying that, gamma is the rate of change to delta. So if we have gamma being 5 cents or 6 cents in these particular underlyings, gamma adds in on the second dollar. So on the second dollar move down from 72 to 71 is what we talked about, this going from $1.60 to when it moves down to 71.38, this 35 cents adds in here. So it goes from $1.60 to $1.95 on that first dollar move down. The second dollar move down to $70.38. This 6 cents adds into the delta. So that next dollar move down would have a 41 cent add in there. So we went on the first dollar, we went from $1.60 to $1.95 on that first dollar. That 35 cents added into $1.60 gives us $1.95. Now that second dollar move, we add these two together, 41 cents to that original $1.95 we have. So now we have a $2.36 is what this premium would be worth. Does that make sense, everybody? Trevor giving me the wolf. All right, so that second dollar move, gamma adds into the delta. First dollar move, it's just delta. Second dollar move, gamma goes to delta. We get 41 cents. Add that into our $1.95 and we get $1.36. Or sorry, $2.36 total on that second dollar move. All right, everybody clear so far on delta being data, gamma goes to delta on the second dollar move. Okay, now theta. Think about theta as the thief. Theta is the thief in the night that comes and steals your premium. Theta is the impact of time on premium. So every day that goes by, this theta dude gets more and more aggressive. As you can see, way out here, 43 days to expiration, the thief only steals 3 cents a day. Okay? Theta steals 3 cents a day from our premium. So today, if our premium's worth $1.60, nothing else changes. The underlying doesn't move. Volatility doesn't move. Everything else remains the same. We're still trading at $2.38 tomorrow. We would expect this go from $1.60 to $1.57 because we lost 3 cents. Okay? Theta, the thief that steals your premium. All right? We have to worry about that as well. The closer we get to expiration, we can see that theta is stealing 3 cents a day here, but way inside, 15 days ago, we see theta stealing 4 cents a day. So an extra penny. It ramps up. He starts getting more and more aggressive the closer we get to expiration. All right? And then finally, what I consider the most important metric of all of the Greeks is Vega, because it really determines our strategy. It determines everything we do in order to set this strategy up to increase our probabilities of success. It doesn't matter if you're getting long call spreads or getting short iron condors, okay? Volatility is the most important thing to look at to determine whether or not I'm going to be doing a call spread long or a call spread short. All right. That is the determining factor. So you need to understand Vega. Volatility is Vega. Vega volatility. It's pretty easy to remember. And Vega is the rate of change in volatility. So the rate of change in volatility, we got Vega right over here. So basically, Vega says for every 1% increase in the volatility, this premium will increase by the Vega, which is 6 cents. Vice versa, if it goes down by 1%, it is going to go down by that 6 cents. and vice versa for all of these different strikes. You can see volatility is going to affect the strikes that are closest to the at the money than the ones that are further away from and out of the mark or out of the money. Okay, so volatility affects, and so does gamma and delta. It's going to affect all the premiums that are closest to at the money more so. All right, and I see a question real quick. Does theta come off on the weekends, and how does that work? Yes, it comes off in the weekends, so you're going to have you plan for that. All right. And volatility has a tendency to spike going into the weekend, Scott, and then coming out of the weekend, volatility has a tendency to come out. So you can play that over the weekend sometimes too. All right, so that is the volatility. So if we are looking for volatility to help us, what would we want to have happen if we were buying this option? We would want volatility to increase if we were buying this option, right? Because if volatility starts to increase, then we get paid that extra couple of cents. And you can see that if volatility started increasing, it could offset some of that theta decay as well. So that's what we're looking for also. We want volatility to increase to help us offset that thief. All right? So all that being said, options 101 behind us. We've got those Greeks kind of down, right? Delta is data. Gamma goes to delta. Theta is the thief. And vega is the volatility, all right? So long put spread. There's two ways to set up the long put spread. Actually, there's three ways. You can go online and listen to how they set it up, and good luck with that. Or you can go follow my rules and set it up one of two ways. Buying the in-the-money put, which is one of my favorite ways to do it. For one, it has higher risk and therefore higher reward. Also, we're able to kind of counteract that theta decay really quickly. We don't have to worry about that theta component. Volatility, we're exploiting that. We're going to be able to exploit a little bit of volatility expansion. All right, so all of those things said, I like the in the money. And when I'm using the in the money put, I'm looking for an 84 delta. And the reason why I look for that 84 delta, for one, 84 delta means that there is an 84% probability of me being, or my strike being in the money at expiration. That's a good probability. The other thing is I would have to have a 10% correction that does not fit my directional analysis to make me lose my entire trade. And the other thing with that being said is we get paid off a lot more. So I like the in the money one. The at the money one is fine. If we're doing the at the money put, though, the one that's closest to at the money, it might be a couple of pennies out of the money, but the ones that's closest to at the money, then we're going to be trying to do a spread where we collect at least a third the width of the strike. So if it's $3 wide, we try to collect $1. If it's $1 wide, we try and collect 33 cents, right? If we're doing the one that I said I like the most, which is the in the money put, and then we're going to sell an out of the money put to help finance that theta component, the one that I like. If we're doing that one, we're trying to pay no more than 50% the width of the strikes. Okay, so if we're doing the in the money 84 delta, then we're looking to collect at least 50% the width of the strikes. If we're doing the ones that's out of the money, then we're looking to collect a third the width of the strikes. Okay, sometimes the in the money won't work and the out of the money one will work. If I really had that directional assumption, I'd probably go with the one that's the out of the money one. All right, so that's going to be along our decision-making process as well. I see a couple of questions coming in. What volatility is considered expensive and should not be bought? Great question. We're going to go over that here. I'll go over that here in just a second when I start going through some of my rules. But a couple of things with long put spread. It is a bear put spread. Could be considered a debit put spread, but you have a bearish assumption, okay? And I talked about the theta and volatility there. So essentials to success. This is where we're getting to that volatility, PD. Picking the right environment. Like I said, when we're talking about environment, the most important thing to talk about is volatility. That's what I talk about when I say the environment around this underlying. Because like we saw the VIX spike today. Does that affect every single stock? Well, a little bit. But every single stock has its own volatility. Tech stocks have higher volatility than utility stocks or consumer staples. All right. So a low volatility for a tech stock might be a really high volatility for a utility or a consumer staple. So we need to determine, like PD is asking, what is high volatility? What is low volatility, right? What is considered high volatility? Well, for each underlying, we got implied volatility percent. The lower, the better, okay? But anything below 50 or where we would expect volatility to be expanding, you know, a binary event, which is like an earnings event, or for treasuries as a FOMC meeting. For the grains, it's the WASDE report, which is like the grain report. The entire financial market tomorrow is the unemployment number. So we always see volatility start edging up a little bit before that binary event because it basically affects the entire complex. So all of those things being said, volatility affects each underlying a little bit different. And a binary event would expect, or we would expect volatility to expand for that. So if you have an expectation of volatility expanding, then you can buy volatility or buy the spread. But I have a rule that anything below 50 is where I would be buying this strategy, and the lower the better. You know, below 30 is really where I would like to start with this spread, because we would like volatility to expand. The probabilities are that volatility will expand if we are super low. So let's just take a look at Qualcomm. And I'm going to get my calculator ready because last week I had trouble doing math in my head, which I usually can do very well, but it was not working out. So I'm not even going to test myself right now. So where is Qualcomm's volatility in relation to where it's been in the past? We can see by this chart where it's been in the past. And we can see as a ballpark where it's been in the past is in the lower 25%, I would say, just by looking at this chart. But let's look at the math. We take a numerator and a denominator, okay? And let's hope everybody can see this because I'm going to try and do this while I'm writing as well. So we take the numerator and the denominator. In the numerator, we have a fraction. And we take where the current IV is minus the low IV, okay? And we take that sum and divide it by the high IV minus the low IV. All right? I know I'm kind of butchering that a little bit. So for this, we're going to take 27 minus 17 just to make math easy. So we take the 27 I saw there, which was the current IV, minus the 17, which is the low IV. We take that sum, which is 10, right? And divide it by the high IV, which is, let's say, 52, minus the low IV, which is still 17. So then 52 minus 17. All right? We take that sum, right? So we have 10 and divide that by a total of 35, right? Yeah, 35. So 10 divided by 35 gives you right around, you know, it's a little bit less than 25%, which is what this is showing on here. But that's because I'm doing the math ballparking. I'm getting a lot 22, 23 kind of thing. But you can see the math, how that math works out. If I'd done the decimals and everything else, then it probably would have come out exactly right. So that's how you come up with where the current idea is in relation to where this underlying felt it in the past. So this would, one would expect IV to expand going forward because it's at its, you know, it's at its 52-week lows pretty close, right? So we would expect volatility to start expanding now, right? Can you view volatility on a chart to see the short-term trend? Yeah, I think you got that. If I recall the past ETF IV be different versus stocks. Wally, you are correct. IV or IV percentile, what's better? I don't know what IV rank is. I go with IV percent, and that's how I figure it out, Marcus. So I would go with IV percentile. All right, so Wally came up with a good point. So for stocks, my rule of thumb, under 50 IV percent is where we would look to buy. For ETFs, under 30 is where we're looking to buy option premium for ETFs. The reason why is because ETFs, you guys, is a basket of goods. It's a basket of tech stocks. And not all tech stocks have as high implied volatility as, say, Tesla. Okay. Some of those tech stocks are going to have much lower. So what happens is the volatility kind of melds each other out where they are in relation. So it is going to have a tendency to remain lower. It'll have spikes that'll go up at above 50, but those don't last very long because of the way that everything averages each other out. But you will see those spikes in volatility and stuff. But yes, buying an ETF is below 30, okay? Stock below 50, but as low as you can go is what I would suggest. All right, picking the right underlying. We've got the environment. We need low implied volatility percent environment, which is when we do that math that I showed you. Now, when we're talking about the underlying, we need to figure out, everybody has their stocks they trade, right? We've all heard of AutoZone and say even Toyota Motors. People don't trade very many options and say like Toyota Motors, despite the fact that everybody's heard of Toyota Motors. It doesn't always correlate. We can see that there is not going to be a lot of volume and open interest in Toyota, like one contract here or there, right? It's pretty random. So these markets are going to be very difficult to get anything going in. Whereas we look at something like Lululemon trading at a close proximity to what that was in price, you can see there's a lot of volume and open interest going on, right? So my rule of thumb with stocks that we're looking at, under $100, the stocks under $100, we need to make sure that these bid asks are within 10 cents from the bid ask on the closest to expiration, the monthlies that are closest to expiration. You could see that fits that rule. Under $100 stock, we need inside of 10 cents wide. If we're looking at a stock over $100 wide, like Lululemon, we just move the decimal place 3 ticks to the left, and that's how wide they should be. Let's say it's 16 cents. We're rounding up 15 to 16 cents. You can see that Lululemon will, generally speaking, fall within that rule. Of course, I'm a monkey's uncle today, and it's not working out. We can look at Visa and see that it's over $100 and it's inside of that 15 cents wide rule. Okay, most of these ones over here on my side will fall within that rule. $200 stock, 3 ticks to the left, 24 cents. You can see that FedEx has that locked up. Okay, so that's what we're looking at, especially if you're a newer trader to options. Don't just go in there and start trading a stock because you necessarily know it in options, because you will have to give up edge to that market maker. He's not going to give up edge to you. Whereas if we're in an underlying where there's a lot of volume and open interest, that means there's a lot of different participants in that underlying, and we're all willing to give up maybe a penny to get our order up front. That's free market price discovery. When there's thousands of us falling over each other to make a better market, the markets get tighter. Okay. If there's only one person in there, he's like, hey, I know I'm the only game in town. You come to me. I'm not going to better my own market. Not very often anyway. All right. So tight bid ask, under $100 stock, 10 cents wide, over $100 stock, move the decimal 3 ticks to the left. That's how wide they should be. $1,000 stock should be $1 wide. All right, picking the right duration. Remember, we want to offset that thief in the night that comes and steals our premiums. This is where he really starts getting aggressive, and even really, really aggressive right here. He knows that the time's almost up. He's got a really clean house. So we want to get out here outside of that theta contraction zone. We're going to offset theta for the most part, but we are going to still have to worry about it a little bit, especially as our directionality or our market moves and our deltas get off a little bit. So we want to go out further in time, for one, to limit that theta decay. Two, if we've gotten rid of most of that theta decay, why not give ourselves the time to be right? Okay? So that's another reason to get out further in time. So just about outside of 45 days, 75, 80 days, I don't even have a problem going out to what would be the December contract closer to 100 days, because I'll show you how we're going to offset most of that theta risk so we don't have to worry about it. So we might as well get out there and get into that. IV percentile, again, low IV percentile environment for a stock is under 50. I like to go as low as I can. In the teens is much better. 0 is the best case scenario, right? For an ETF under 30 IV percent, because there's a lot of different volatilities in there that offset each other. Picking the right strikes. Let's get to the important stuff, right? How do we set this thing up? Sorry if I'm blasting your guys' ears off. I'm a little excitable today. So we said outside of the 45 days we want to go, which in this case is going to put us to that January. We got to skip December. It's got IV percentile below 50. So we are seeing IV start to expand. We can see that January contract we're going to be getting involved in is going to have a binary event in it. And what do we usually say going into binary events is we'll see volatility start to expand. Something crazy happened right in here. That was during those big market moves early on in the year. That's why that volatility expanded. But you can see that coming into this binary event, we expanded, boom, came out of it, started contracting, coming into it, expanded, coming into this one, expanded. We would expect coming into this one, we would expand as well. So we are getting into an area where expansion is likely, okay? So those are some of the things we need to go through when we're setting up these strategies. Not only am I directionally bullish or bearish, but where is volatility and can that help me out with my market assumption? Yes. If you pick the right volatility for the right strategy, then I talked about this in the daily market commentary on a strategy I just took off. I did take it off for a loser, but I was directionally wrong quite a bit. But as volatility was expanding on that downward move, it was offsetting a lot of my losses. So that helped. I bought volatility kind of there. I bought also the expand, or I thought that the market was going to go north. It went south, but because I bought the option contract, the premium and volatility expanded, it kind of helped offset my directional incorrectness, right? So that's why we set those up to help out when things go awry. All right. So picking the right strikes. So let's go look at a couple of things that I was looking at. Sorry, I've got my charts versus my thing all wanky. So picking the right strikes. We talked about this with the 84 delta. So we're going to look in here and look for the 84 delta. The closest one I can get to 84 delta is this one right here. One thing about this will act as like a synthetic short with limited upside risk, like a synthetic short, and then you bought a call. Or if you thought about it as, a long, on the long side, this would be equivalent to having a synthetic put in there to limit our risk to the downside. This has a synthetic call in it to limit our risk to the upside because we have no risk above 270, right? So what we want to do is start with this delta here, and we're going to buy that one, the 84 delta. One thing little hack we have here is how much intrinsic and extrinsic value is there in this option premium. Any option that's out of the money is all extrinsic value. Premium or options premiums that are in the money have intrinsic, which is what this is actually worth, and extrinsic value, which is that theta component and volatility and all of those things that can decay to zero. All right. So if we're doing the 84 delta in the money, we know this 270 strike has about $28 in intrinsic value, because one thing we can do is go for 270, that's that strike, to 239, that gives us $31. Did I do that math right? 31. Yeah, $31. So $31 is the intrinsic value. All right. That's what makes this valuable, right? Makes it worth what the underlying is trading, $31. So everything else is extrinsic value. Well, you can see it's kind of wide here. How do we figure out what extrinsic value is? Well, we have to do all that math I just talked about, or simply look over here to the other corresponding call, and that being all extrinsic value gives us a hint to very close within a dime or so what the extrinsic value of this option is as well. So if we sold this one, or if we're buying this one, what do we need to sell to pay for that extrinsic value? Well, the extrinsic value, this says, is about $2 and some odd cents. So that's the closest one we can find to pay off all that extrinsic value. Now we don't have to worry about that theta decay at all, because we've over financed. Remember, the value of this is $31. We're only paying $30 for it. So we have made our break even above where the underlying is trading, right? If we subtract to find our break even $30, let's just make it easy, $30 from the $2.70, that means that this put is worth $270 minus the $30. That means that this is worth $240. So that, in a sense, is saying we are shorting FDX at $2.40, almost $1 higher than where it's trading now. How often do you guys get to sell a stock above where it's trading by $1? Or vice versa, if you were doing it with calls, buying a stock below where it was trading for $1. So that's the beauty in options, is we're able to do that. Now, the next thing I said, that works out. Now we have to look at the width of the strikes, right? I did the in the money one. So my rule is I have to at least pay less than or equal to 50% the width of the strikes. Well, we are $60 wide, paying $30. That is 50% the width of the strikes. That works out. That one would be a good strategy to have, right? So that works. The other one would be to pick the one that is just at the money, which I would say this 240 one is closest at the money. We can buy that one and sell the 220s. I got a $20 wide strategy, and my rule of thumb is 33% the width of the strikes, right? So if I have a $20 underlying, then if it's $20 times 0.33, how wide should it look? $20 times 0.33, third the width of the strike, $6.60 is what I should be thinking I should have to pay. I'm paying less than that. I'm sorry, I can't read. Paying slightly more than that. So I would go with the other one, right? That's where I was talking about, where you're going to kind of make a decision. For this one, I'd go with the in the money. I've gotten rid of all theta decay, so I don't have to worry about that thief in the night. Also, I have a higher risk reward, which is always what I'm looking for, and it fit my rule. This one's a little bit outside of that. I'd probably go with the other one then in that case, okay? All the time we learn it from you. What's that? What about in and out quick weeklies to avoid gamma? John, I do gamma trades and stuff like that to talk about the gamma. Another thing I try to avoid with the gamma is getting further out. And the further out in time you get, the gamma is not going to affect that as well as either. Okay. Does that make sense? Okay, good. All right. So that is picking the right strikes. And we'll go over a couple more examples here in a second after I get through all this stuff. So knowing your exit strategy. All right. When I'm looking at my 84 Delta one, I look to have my debit increase by 33%. It's going to be flipped, okay? So when I get 50% the width of the strikes, increase of 30%. So that one was a $60 wide, and we paid $30, right? So when this premium increases by 33% times 1.33, right, equals $39. So I'd be getting out like right around $40. And I would write that down. And I think one thing I forgot to mention in the last webinar is every time you guys do a strategy and you're going to put it on, whether it's in your trading account or you're learning in your paper account or something like that, write down all the trades that you did, what the implied volatility was in and around that. Was it low? Why? What your directional assumption was and why? And ultimately put down where your exit strategy is. I can't tell you how many times I've seen traders say they're going to get out a specific place, and then when it gets to that place, they squeeze it out a little bit more. And then the next day they realize I should have gotten out where I said I was going to get out. And it doesn't matter if it's coming down to a support. Whatever your strategy is usually to get out. If you're using a support and resistance, whether it's Fibonacci or the Ichimoku, whatever the heck the clouds are, Bollinger Bands, all of that stuff. Whatever your exit strategy is, stick with that. Write down what it is, though, so you have, and stay consistent with it. So you have the data to go back and look and say, hey, is this working with these support and resistance levels? Should I be using Fibonacci rather than Bollinger Bands and stuff like that? All right. I usually use Fibonacci and the market profile. I teach how to trade market profile also in different webinars that are in the archives that you guys can look at. But that being said, stick with your exit strategy and always have. So on the plus side for me, on the one that's in the money, increase of 33%, right? Collect 50% the width of the strikes on the in the money one, and we get out for a 33% increase. On the one that is out of the money, we looked to collect 33% the width of the strikes. Now we look for an increase of at least 50%, okay? So 33 cents, when it goes from 33 cents on a dollar wide to 66, actually it's 100% increase, I'm sorry. 100% increase, I think I did that last week. I have it written in my notes, 50%, and that doesn't make sense. So 100% increase in the value of that option. So it goes from 33 cents on a dollar wide to 66 cents. That's where I'm getting out. And most likely that increase of 100% increase in my premium is usually when my short strike is being tested. That one that I sold that either paid for the extrinsic value or the one that defined or helped finance some of the spread on the out of the money. So when my short strike is reached during the duration of that strategy, that's usually where I'm going to see that increase that I'm talking about. So we're just looking to beat those probabilities. Remember I talked about delta being the probabilities a little bit here. You know, so when I was talking about shorting like this one, this is that 15 delta. Well, delta tells us the probability of being in the money by 1 penny at expiration is 15%. So that means at expiration in the next 100 days, this being in the money by 1 penny, trading, the underlying's trading 109.99 on the expiration date is 15% probability, you know, on that 1 penny in the money, excuse me, or further. Okay, it's just saying that it will finish in the money by at least 1 penny. But one of the things that I taught you guys as a floor trader, we learned that, or we came up with, 2 times the delta is the probability of being kissed or being touched or being tested, however you want to say. During the next 160 days, there is a 30% probability that FDX will come down and trade 110 even, at least 110 even in the next 100 days is a 30% probability. It may trade it one time, 1 second, and never see it again. The probability is it happens once, and that's 30% probability, and that's when we're looking to get out. We beat the probabilities, right? 30% probability of being tested, we get hit on that. I'm looking to get out. Okay? So know your exit strategy. I like to get out when I get this, my increase of premium is by 33% on the 84 Delta, and on the one that is at the money, I'm looking for 100% increase in my premiums. All right, so let's go over a couple of other things real quick before I get into all the examples. I know I'm getting long-winded today. Max profit is our long put strike minus the short put, which is the width of the spreads, right? In that one example I gave you, it was $60 wide, minus the net premium, which in our example was $30 wide. So $60 minus the $30, our max profit in that example was $30. Now, our max loss is the premium paid, that $30 we paid. On the ones that are at the money, you know, we had a dollar wide underlying with 33-cent premium. Our max profit is 66 cents. Our max loss would be the 33-cent premium. All right. Our break even is our long put strike minus the net premium, right? So because I kind of went over this briefly, our in the money strike minus our net premium. So $30 wide. We take the $30 minus the $270, and that means our break even is at $2.40, right? That's where we sold this underlying $1 higher than where we currently are. All right. That's why we want to do it like that. Get that dollar edge. I mean, you got a dollar edge already. It's basically almost where I was going to say you almost sold it at the beginning of the day. Not really. All right. So this is the part of the webinar where I want to throw it out to you guys to throw out a couple of examples, and we'll go over them. All right. Somebody's throwing out Target, hating on the retail sector. So we don't have to worry about earnings so much in this one. There is earnings coming up because we're buying this premium, and volatility expansion will help us a little bit here. It's mostly offset, but it will help in and of that self. So I don't have to worry about the earnings event. Now, on a dividend, we kind of had to worry about this on the long call spread, because on a dividend, for instance, this underlying said it had a dividend, ex-dividend date was 64 cents. So on that date, the underlying is supposed to drop by that 64 cents because people who buy the stock on that date don't get the dividend. So the idea is if I buy it on that ex-dividend date and I don't get the dividend, I should be compensated for that dividend in a lower price underlying or stock. That being said, we had to worry about that on the calls. We don't have to worry about that on the puts because we want this market to drop, all right? And, you know, somebody might be out there saying, well, it's going to be priced in. Yes, it could be, but it might not be priced in on these longer duration contracts that we're using because they're too far out before they come up with when they're going to release their earnings, okay? So, but we don't have to worry about that so much with the puts because we want that directional move. It doesn't always happen. Sometimes, as you can see here, we had an ex-dividend date here of 62 cents. The market did not sell off by that 62 cents. So it's just it's a theory that it's supposed to do that. It doesn't always do that. So that being said, we don't have to worry about that so much. So Target, it has low implied volatility. We could do the math on it. Current IV minus the low IV in the numerator. In the denominator, we take the high minus the low, divide those by each other, and we get 8.76. See how I did that in my head? No. Nice try. So really low implied volatility. So we would have to expect that when it's this low, it goes up, right? So we're safe there. Let's look at the 84 Delta. We could look at the product depth or all that stuff. But so the 84 Delta is going to be, let's say, this 95 put. So the 95 put, and then let's just look over here. How much extrinsic value do I have to try and collect to pay off this? At least $1. I can do that with the 75. So I've got a $20 wide and it's slightly over that, right? So if you are really bearish in this underlying and really expect the volatility to expand, I would say, this is close for government work to get into this trade. You can also start out a little bit lower and work it in. That's another thing, you guys. If you don't have a ton of cancel replaces, you aren't doing your job. You don't have to pay for cancels. You do have to pay if you give up too much edge, because that means you lost a couple of pennies here and there. And that will add up over the course of your life, even the course of a year. Those pennies will add up to substantial amounts of money. It could even just be enough to pay off this commission I have to put in, if I went down by 3 or 4 cents and consistently did that. All right. So always do that. Put that in. I'm not saying wait an hour before you cancel replace. Put it in there. It's enough time for it to meld. Go in there, cancel, replace, every 5 seconds, cancel, replace until you get it. But this, I would say, is closer to a yellowish light when you go over that, but it's pretty close. All right, so that, the best case scenario would be it's less than $10 wide. All right, the other one we could be looking at, the ones that are close to that, the money, I would say, are these 85 deltas. All right, that's just slightly in the money. And then we're going to say, let's go $10 wide and $10 wide, $33.21. That's less than that third the width of the strikes, right? So we are good there. So this one probably a little bit better than the in the money one, flipped from the last one we did, right? So always double check these. Make sure which one comes the closest to the rules and fits within that, because you might need to check both of them. One of them works out better. Why not just use the IV on the right side of the platform? You can, John. I'm doing this for some people don't all have TD Ameritrade and stuff like that, or have the IV. They may just have the chart or have a way of finding out what the current IV is and stuff like that. So I want everybody to make sure that they know what that is. There's also times where the implied volatility is broken in the chart and it won't give you a reading. So therefore, you're going to have to know that math in order to come up with it. I have people that I used to trade with on the floor would only do the last 6 months. And therefore, they felt that that was a cleaner representation of what, the underlying was going through currently. And he doesn't trade outside of 52 weeks. So why would he look at that outside of 50? Those kind of things. So in that case, then you would need to come up with your own math to do it as well. All right. Does that answer your question, John? All right. Will you be sending a recording? I'm kind of slow at this math stuff. Thank you. Yes, Scott, we will. And please watch it again relatively soon, because that's when everything's going to start clicking. All right. Because right now, it's kind of like when I start doing the math in my head and I start messing it up. It's because my head's swirling, right? I'm trying to think of the next thing to say. I'm trying to read a question from somebody else and I'm trying to do math in my head. It just doesn't work. I get lost. So I get what you're going through. Can't beat toss. I agree with you. I think it's the best platform out there, but I'm biased too. I have a bunch of friends that started this. So, okay. So Target works out that way. All right. Now, let's look at another one that I vetted before we get going too far. And that was in an ETF. So I'm going to look at an ETF, XLK, because we are kind of getting close. So XLK, technology ETF, obviously technology was getting spanked a little bit today. And you can see we had a drop, but it came back. Volatility starting to expand. And this is what I was talking about with ETFs. You're going to see these spikes in volatility every so often, but it doesn't remain up there very high. But we're looking for a spike when we are really low. And it feels like one might be coming on, so that's good. All right, so ETF, it still goes by the rules of, does it have 10 cents? It's under $100. I need at least 10 cents wide. And because it's aftermarket, we are getting crazy markets in here. So I'm going to skip XLK. In my course, when I vetted this one, I was getting some crazy good spreads on here, like a quarter of the width of the spread when I did the, I was doing the D's. So let's look at the Ds. Yeah, they're all over the place now because the market's closed. Nobody left their orders in there. All right, so I'm going to skip that one. Let's see if XRT did the same thing, because that was another one I was looking at. XRT, the retail sector, was getting spanked. All right, people left their orders in here. Good. All right, so a under $100 stock inside of 10 cents wide. You can see that I'm telling you, we usually are inside of 10 cents wide. So with XRT, let's just look at this one. Dece is where we're going. 84 delta. This is closest to the 84 delta. You know, it's just the closest to, you know, and if I were to veer one way or the other, I would likely go to the closest to the 84 delta this way rather than this way, okay? So I always kind of inch it in. But having said that, let's start with the 53 and see how we come up with this, how this works out. So we got the 53 put. 30 cents, we've got to come up with a pay, right? We got to pay off 30 cents. That's, you know, we can pick either one. Let's go with $10 wide. Try and do the math easy. So we bought the 53s, sold the 43s for $4.23. That's less than 50% the width of the strikes. That is a really blazing green light. I mean, that is about as good as you're going to see. All right. So that one works out as well. Now, also remember we paid off the extrinsic value, so we don't have to, the extrinsic value. We can look at our break even. The 53 minus the $4.23 gives us $48.77. Did I do that math right in my head? $48.77. So we're basically able to sell this above where the underlying is trading again. Less than 50% the width. Now, when this would increase by a third, that's where I would get out of this strategy. This one being the closest to at the money, the 49s. Go for that one. Let's just try and go $3 wide. Usually a $50 stock, it's about $3 wide to make my rule work. And that works out. So $3 wide, $1, that's right around a third the width of the strikes. And when it's at $2, that's where I'm getting out. Does the market profile usually align with fibs? John, I believe it does. And I don't know if the fibs are making the market profile good, or if the market profile is making the fibs good, or vice versa, you know. And are the fibs working because everybody looks at the fibs? You know, I don't know. But I have a tendency to believe that these are going to fall in line with the Fibonacci's very closely a lot of times. And you can see I wrote, this is a Fibonacci extension too, so, but it's very close in line with it. And I like the market profile because, like I said, when I started trading in college, I had a psychology degree, and this to me tells you where people are putting their money where their mouth is, and that's really the psychology of the market. When you get over like this is capitulation, to the upside capitulation, and right in the middle, everybody's happy. Monkey bars, I do both. I look at both. Because on the floor, we used to look at monkey bars, and now we look at market profile. Monkey bars are the time, and that's why we used to do it, because we didn't have like really updated data on where volume was trading at each individual strike back in the day. So Stoudemire started this whole thing by doing the time frames, assuming that if it basically spent a lot of time at those levels, you were going to see volume at those levels as well. All right, do you guys have any other questions? What MAs on the chart? MAs, I'm not sure what that is. Are you talking about these lines here? These are my moving averages. Oh, I have a 9-day, 50-day, and 200-day moving averages. So the blue is 9-day, 50-day, 200-day. Okay. All right, guys. I mentioned daily market commentaries. This premium membership offer gives you those daily market commentaries where I talk about every single trade I do, when and where I do them, whether they're a winner or a loser. I don't cherry pick anything, you guys. The day I put them on, I'm telling you about them. either on Twitter or I'll talk about them in the daily market commentaries or when I'm taking them off. So watch those daily market commentaries because, you know, like eBay's been going against me and I'm talking to you guys about how you manage those strategies that go against you, probably more so than the ones that are working for you. I talk about all of that stuff. I also go over all the economic data, how I think it's going to affect the overall markets. You know, like yesterday, I was talking about oil having a correction after the oil inventory numbers, and what we got that starting to happen today. All right. Also, so you get those daily market commentaries. We've just added a whole new section where you're getting a lot of newer archived videos. Those are going to be added in as well. You get that as a bonus for doing the premium membership, where you can go through all my archived videos. Like I said, if you watch this put spread video, the last put spread video, I may have done something on it. It would have been built differently or discussed differently. So check that one out again as well to kind of help you solidify some of this, you know, watching the same video again. It doesn't have to be the exact same one. Watch one of my videos on long put spreads again. And you also get access to these webinars. You get early access to it. And you have unlimited access to me, which could be the most important or most rewarding thing for you guys, is that if you have a problem or you're seeing a strategy go wrong and you're like, hey, what would Wolfman be doing in my position? I can tell you what I would do. I can't give you advice as to what I think you should do. I can tell you what I would do. And I'll go back and forth with you on as many emails as I can to make sure you're clear of concept. And if I can't get it done in an email, I hate writing long emails, just so you know, I would reach out to you and say, hey, let's get on the phone and like figure this thing out. So you get unlimited access to me with your premium membership offer. And I know quite a few of you guys, I'm not going to mention everybody's name, but there's several of you guys that take advantage of that. And I think that's great. I think you guys get a lot out of that. And you get the lesson archive videos, which is basically there's some shorter videos, like 15 minutes refreshers. So like if you're like, oh, I watched that video on Iron Condor about a month ago. What were those rules again? You can watch the 15-minute video and just get the rules real quick. You don't have to go through all the explanation of all the details of delta and gamma and all that stuff. All right. So take advantage of this, you guys. 2 months for the price of one is unbelievable for what you're going to get out of this. Also, I'm going to be talking about the earnings trades coming up. And if you guys want to learn how to trade earnings, that will help. And I also talk about basically every strategy I do and go through those rules as well. So when you guys are in the right tools, you guys, for the right situation, you guys are going to be more productive state of mind and put your guys, be able to allow you to put on more strategies. And when you are able to put on more strategies, you guys are going to be more confident, all right? And then ultimately, you are going to have higher probabilities of success. This link is in the chat window, you guys. If you're watching this on tape delay, you're going to have to pause it and just type this into your URL. It's not a hot link right there, but it is in the chat window. We've been going back and forth in the questions box. Check it out over there in the chat window. Click on that. It is a great deal, especially because you get all the videos, you get all the daily market commentaries, which I think are extremely important, you guys. I know a lot of you guys have gotten a lot out of those, and you have told me I appreciate your good feedback as well. But take advantage of this, because the only way to become a better trader is to constantly learn. And you guys obviously taking the first step in that, but the next step is to stay consistent with that, right? And I teach how to trade with higher probabilities and ultimately increasing your success rate. All right, so I just want to thank you guys all for participating in this. Later webinars, I'm going to be drilling down on different option components and how I trade options. Trades I find, when and where I find them appropriate. You have to take them into account with your risk tolerances. Here's also the link. Again, not a hot link. You're going to have to pause, type this in. Thank you guys all for watching. And I see a couple of questions popping up. I'll get to you guys here in just a second. But in later webinars, if you have any questions, reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. The link is in the window. Take advantage of that. I highly suggest it. And that's about it. Other than if you can't take that, take it easy. All right, let me grab a couple of those questions again. How long are the market commentaries and what time? John, the market commentaries are, I try to keep them about less than 10 minutes long, but, as I try to keep these webinars on less than an hour long, I have a tendency to ramble a little bit. So they're about 10, 15 minutes. I go through, spend about 5 minutes on all the economic data from across the pond to here. And then I go through basically all the charts, gold, oil, Bitcoin, all of the different charts there. And then the stocks all through the equities. And then the stocks that I'm looking at trading, whether I'm getting in and out of them, where I got in them, and all that stuff. I don't do Twitter or Facebook. How would I get trade alerts? I don't do trade alerts other than on those daily market commentaries. That's the trades that I'm doing. We are talking about doing a live morning session. We haven't nailed down the syllabus on that, but soon we are going to bore you with my morning regimen. Hey, take it easy, JQ. Thanks, Scott. Appreciate it. All right. Anybody else have any last second questions before I sign out? All right, then, man. You guys all have a great one. Take care. Sorry, Wally, I didn't realize I was on mute. Do you get that whole thing with how I changed those? Simple moving averages is what I've got on those lines. And I had to change this one from 9 to 50 and change this one from 9 to 200. To all prospective members, Eric's great. The $99 best ever spent membership to take one advantage of Eric's in a good way. Thank you very much, Ted. Take care, buddy. I should have read that earlier, maybe.